Hospitals across Indonesia are currently operating under the immense strain of a chronic disease crisis. Millions of patients require continuous, expensive medical intervention for conditions like hypertension and stroke. This diagram compares the World Health Organization's daily recommended sodium limit, under 5 grams, against the reality of the Indonesian diet. The average citizen consumes 10.5 grams of sodium every single day, largely driven by a shift toward ultra-processed foods. This chart shows the exact fiscal penalty of that excess consumption. In 2025, the National Health Insurance System, BPJS Kesehatan, is projected to spend Rp50.2 Trillion simply managing chronic diseases. The vast majority of that deficit stems from 2 specific complications linked directly to high sodium intake. Nearly 30 million cases of heart disease costing Rp17.3 trillion, and 12.6 million cases of kidney failure costing Rp13.3 trillion. That Rp50.2 trillion gap represents a massive, uninternalized negative externality. Because the true cost of an unhealthy diet is deferred to the state, the broader public is forced to subsidize private consumption habits. The standard economic solution to this problem is a Pigouvian tax. A Pigouvian tax is a levy applied to a market activity that generates negative external costs, designed to force the price of a good to reflect the social damage it causes. In Indonesia, the primary vehicles delivering this excess sodium are cheap, widely available, and heavily marketed ultra-processed foods, like instant noodles and packaged snacks. The government already possesses the explicit legal authority to tax these specific items. Government Regulation Number 28 of 2024 mandates the control of sugar, salt, and fat, specifically allowing fiscal instruments to target processed foods. Yet, the policy remains completely paralyzed in the legislative pipeline. Executive leadership has repeatedly hesitated to enact this tax. The prevailing political logic prioritizes short-term macroeconomic stability, fearing that a new tax on mass-market goods could disrupt baseline economic growth. The barrier preventing a sodium tax is not a lack of medical consensus, and it is not a lack of legal authority. The delay is a predictable market dynamic explained by public choice theory. This matrix shows the legal blueprint established by Law No. 39 of 2007. For a good to be taxed, to become a barang kena cukai, it must strictly satisfy 4 specific criteria. First, its consumption requires control. At double the WHO limit, sodium qualifies. Second, its distribution requires supervision to ensure accurate nutritional labeling and prevent consumer deception. Third, its use causes wide-ranging negative impacts, evidenced by a national hypertension rate of 34.1% in 2018. Finally, a levy is required to balance the state's fiscal burden, offsetting the massive BPJS subsidies. Sodium satisfies every statutory requirement needed for a good to be taxed, yet it remains untaxed, a gap between legal reality and policy execution that requires a deeper look at how decisions are actually made. Public choice theory is an economic framework assuming that politicians and bureaucrats act as rational maximizers of their own utility, prioritizing votes, stability, and influence, exactly like commercial actors prioritize profit. This scale illustrates the political market surrounding the sodium tax. On one side sits the anti-tax coalition, led by major food and beverage associations. They wield immense economic leverage, contributing 6.55% to the national GDP and absorbing a massive portion of the labor force. Because an excise tax threatens concentrated financial losses, massive corporations possess an overwhelming incentive to spend capital and actively lobby the government to halt legislation. Contrast that with the pro-tax coalition. The benefits of the tax are dispersed across 270 million unorganized citizens. Without unified financial backing or a single lobbying voice, the scale tilts entirely toward the industry. This creates a state of rational ignorance. For the average citizen, the time and effort required to study food policy and lobby lawmakers far outweighs any immediate, tangible benefit they might feel. As a result, grassroots pressure drops to zero. In this political market, concentrated industrial wealth will always overpower dispersed public health needs. The policy will only pass if the financial and political incentives of the lawmakers change. Instead of fighting the law publicly, industries often rely on regulatory capture. Regulatory capture is a form of rent-seeking, where an industry manipulates the technical rules and benchmarks of the agencies meant to regulate it, protecting its profits under the guise of compliance. This table outlines the 2025 BPOM draft regulation for Nutri-level labeling, focusing specifically on instant noodles. To legally claim a healthier choice label, the product must simply fall under a maximum threshold of 900 milligrams of sodium per 100 grams. Medically, that threshold is incredibly loose. A single serving at 900 milligrams represents nearly half of the WHO's absolute maximum daily limit, delivered in one meal. Setting the benchmark here allows major brands to make minor recipe adjustments, evade future tax thresholds, and legally market high-sodium products to the public as healthy options. The 900 milligram benchmark is not derived from cardiovascular science. It is a mathematical artifact of rent-seeking, calibrated specifically to protect corporate market share. The anti-tax coalition does hold one highly legitimate macroeconomic argument. A flat tax on food is inherently regressive. This curve demonstrates the core problem. Lower income brackets rely heavily on cheap, ultra-processed foods as their primary source of daily calories. Consequently, they pay a sharply higher percentage of their income toward the tax compared to wealthier households. Furthermore, small and medium enterprises, the local snack producers, lack the capital and technology to rapidly reformulate their recipes. A sudden tax threatens them with bankruptcy and mass layoffs. Without a built-in mechanism to protect consumer purchasing power and vulnerable labor, implementing the tax guarantees massive social backlash, rendering it political suicide for any sitting administration. To solve the regressivity paradox and break the political stalemate, the government must utilize revenue earmarking. This fiscal policy legally binds the income generated by a specific tax to fund a specific public program, rather than vanishing into the general state budget. The primary international precedent for this strategy is Hungary, which successfully implemented its public health product tax in 2011. This flow model tracks how Hungary deployed its tax revenue. Instead of diluting funds into the national treasury, money flowed into two targets: research subsidies and the healthcare sector. This highly calculated move funded a 25% wage increase for 95,000 healthcare workers. Applied to Indonesia, earmarking solves the public choice dilemma. By tying the tax to hospital funding, the state artificially creates a highly organized, highly motivated interest group, healthcare workers and BPJS administrators, with the political power to counter-lobby the food industry. The remaining revenue then acts as a financial carrot, subsidizing the expensive research and development costs for smaller enterprises, allowing them to reformulate their products without facing bankruptcy. Success depends on engineering the political market. By using revenue to build new, motivated coalitions, the state can shift the balance of power back toward the health of the public.